In early 2021, something strange happened on Wall Street. GameStop, a dying retailer most people hadn't thought about since the Xbox 360, suddenly became the most talked about stock in the world. And not just talked about, it was skyrocketing. Its price didn't just rise, it exploded. Hundreds of percent in days. No new product, no profit. In fact, the company had lost millions and was widely expected to go bankrupt. As one analyst put it, the fundamentals were heading in the opposite direction of the stock price. And yet, the stock kept climbing. Major hedge funds like Melvin Capital were blindsided, losing billions as they scrambled to cover their bets. So what happened? How did a struggling video game store become ground zero for a financial rebellion? And what did it expose about a system Wall Street always claimed was too big, too smart, and too safe to fail? To understand what happened, we have to go back, way back, before Reddit, before Robinhood, before the chaos, back to when GameStop actually mattered. The company went public in 2002 and quickly became a fixture in shopping malls. You'd walk in, grab the latest PlayStation or Xbox release, maybe trade in an old game for store credit. It was simple, tangible, a core part of gaming culture. But as the years rolled on, the industry changed. Gamers stopped buying discs. Digital downloads took over. GameStop started to feel like a relic, stuck in the past, while the rest of gaming had already moved online. There's been basically a 15-year trend away from packaged video game distribution to digital game distribution. Sales slipped. Stores closed. Most people assumed it was only a matter of time before GameStop faded into retail history. But then came a twist no one saw coming. In August 2020, a new name entered the picture: Ryan Cohen. He wasn't a gamer. He wasn't a retail veteran. He was the guy who built Chewy, the online pet supply company that sold for billions. Quietly, he started buying up GameStop stock, 9 million shares, totaling $76 million. No press, no interviews, just filings. And when those filings hit in November, people took notice. But Cohen wasn't just betting. He sent a letter to GameStop's board urging them to ditch the dying retail model and build a real e-commerce strategy. By January 2021, GameStop added Cohen and 2 of his former Chewy executives to the board. That same day, the stock jumped 13%. It was a clear signal. Something was shifting. But the real explosion? That wasn't about Cohen. At least, not yet. But by then, something else was already in motion. A very different kind of force. Quiet, scattered, and online, was starting to build. It wasn't about GameStop's future. It was about short selling. Here's how it works. A short seller borrows shares, say 100 shares of GameStop, and immediately sells them at the current price, betting the stock will drop. If it falls, they buy the shares back at the lower price, return them, and pocket the difference. In simple terms, it's a way to profit when a company fails. And no company was being shorted harder than GameStop. At one point, more than 130% of its available shares had been borrowed and sold. That wasn't just aggressive, it was nearly impossible. Hedge funds were betting against GameStop so heavily that they had shorted more shares than actually existed. That's when a new group stepped in. Not hedge funds, not analysts, Reddit users, small-time investors, what Wall Street dismissively calls retail traders. Most of them didn't wear suits. They didn't have Bloomberg terminals. What they had were smartphones, and a growing sense that the game was rigged against them. In just 1 year, around 10 million new brokerage accounts were opened. Commission-free apps like Robinhood made it simple to jump into the market. You could buy, sell, or day trade with just a few taps. And with the world in lockdown, millions of people, bored, isolated, and online, started watching the markets like never before. But in 2021, trading didn't happen in isolation. These 10 million new investors were connected, talking to each other, reacting in real time, and at the center of it all was one forum, Reddit's Wall Street Bets. This wasn't your average investing group. It wasn't polished. It wasn't professional. It was loud, chaotic, and unapologetically unfiltered. The subreddit described itself as, like Forshawn found a Bloomberg terminal. And honestly, that felt pretty accurate. The posts were wild, full of memes, slang, and self-deprecating humor. But under the noise, something real was brewing. A movement. The forum had become a hive mind for day traders. They shared tips, posted screenshots of wins and losses. They rallied behind stocks they believed in, sometimes for fun, sometimes out of spite, but always together. When they picked a target, they stuck with it. They told each other when to buy, when to hold, and most importantly, not to sell. GameStop wasn't just a trade, it was a mission, a shot at beating Wall Street at its own game. What started as a joke began to look like a movement. Even some billionaires started cheering them on. The energy spread from Reddit to Twitter to the mainstream, and that's when everything flipped. It turned into a short squeeze. A short squeeze happens when the bet backfires. Imagine you borrow GameStop stock at $30 and sell it, betting the price will drop. You plan to buy it back at $25, return it, and pocket the difference. But instead of falling, the stock starts climbing. $31 to $33 to $35. Now you're trapped. Do you wait and hope it drops again? Or do you panic and buy it back before it climbs even higher? That's the squeeze. As short sellers start scrambling to cover their positions, they're forced to buy back shares. Fast. But all that buying just sends the price up even more. It's a chain reaction. More panic, more buying, more upward pressure. Now you're not buying it back at $25. You're buying at $35. That gap, that's your loss. And every short seller caught in that loop is bleeding. Meanwhile, Reddit traders are holding the line, buying more, pushing the price higher, and watching the squeeze do the rest. And it worked. There were enough of them, millions of Reddit traders, pouring in with enough volume to squeeze some of the biggest short sellers on Wall Street. What started as an internet stunt was now having a very real and very expensive impact. Hedge funds began buying just to stop the bleeding. And that buying, it only sent the price higher. Sure, plenty of Reddit traders were in it to make money. But for many, this wasn't just about profits. It was about payback. They weren't just trading. They were fighting back against hedge funds, against the system, against the idea that Wall Street always wins. For once, they wanted the little guys to win, and it wasn't just talk. Melvin Capital, one of the biggest short sellers, was forced to close its position, losing billions in the process. Citron Research, another major short player, admitted defeat. Andrew Left said his firm took a full 100% loss. This was no longer a meme. It was a chain reaction, and it was spreading across the entire market. And GameStop was just the beginning. Reddit traders turned their sights to other heavily shorted stocks. AMC, Bed Bath & Beyond, and BlackBerry. Prices soared. For a moment, it looked like retail traders were rewriting the rules and beating Wall Street at its own game. But the market was overheating. GameStop, a struggling mall chain, had hit an all-time high. Experts warned of a bubble. The SEC started paying attention. We, of course, respect the role of regulatory agencies. They are closely monitoring the situation. Then came the backlash. Some wondered if this was still grassroots, or if big money had quietly joined the frenzy. Suddenly, brokerages stepped in. TD Ameritrade, Schwab, Robinhood. They began limiting trades. Robinhood, the app most retail traders were using, restricted buying altogether. Users could sell, but not buy. Accusations exploded. Was the system stepping in to protect the pros again? Washington noticed. Lawmakers called for hearings. The SEC launched an investigation. Meanwhile, GameStop said nothing. And as the dust began to settle, so did the price. Hedge funds like Melvin Capital had lost billions. But so did countless retail traders who got in too late, chasing a dream that collapsed just as fast as it rose. What began as a rebellion ended in confusion, anger, and heavy losses. As billionaire Lee Cooperman had warned, "I'm not defending them. I'm just saying, from my experience, this will end in tears." And for many, it did. But the impact was undeniable. A meme stock rattled Wall Street. Hedge funds bled. Congress paid attention. And the world watched as a group of retail traders, armed with nothing but apps and attitude, briefly flipped the script. For once, the little guys didn't just watch the game. They played it. And for a moment, they changed it.